Hello and welcome to the latest tax snacks from Old Square Tax Chambers. I'm Sarah Squires and I'm going to be talking about the two new temporary corporation tax reliefs announced at the budget. The two reliefs are an extended loss carryback for trading losses only and the so-called super deduction. Both measures are intended to assist businesses coping with the difficulties of COVID, but they work in very different ways. The extended loss carryback is giving businesses an opportunity to monetize their COVID-related losses through tax reclaims, whereas the super deduction is all about looking forward and encouraging new business investment in order to stimulate the economy post-pandemic. Starting with the extended carryback, this relief is only available for trading losses only and very much builds on the existing carryback relief under which trading losses can be carried back and offset against total profits of an earlier period. The existing carryback relief provisions only allow you to carry back a maximum of 12 months, unless of course you are within the terminal relief provisions. The extension to carryback means that trading losses can be carried back for up to a further 2 years, meaning a 3-year carryback in total. The reason the relief is temporary is because it is only available where the trading loss arises in an accounting period that ends sometime between 1st of April 2020 and 31 March 2022. So if you have a company with a calendar year end, then the extended carryback is available if there are losses in either or both of the company's accounting periods ending 31 December 2020 and 31 December 2021. Where relief is possible, you need to be aware that the rules require you to use your trading losses against later years before earlier ones. So if you have a loss in the period to December 2020, you would first use that loss against any profits in the period to December 2019, and it's only if you then have losses remaining that you can use the extended provisions. Where the existing rules apply, which is the 1-year carryback, the only limit is the amount of total profits in the period to which you're carrying the losses back. But when it comes to the extended carryback, there is an additional limit, a cap on the maximum relief you can obtain. That cap is 2 million of trading losses per loss-making period. So if you have a company that has a loss of, say, 3 million in its accounting period to December 2021, if it's looking to use extended carryback, it can only use 2 million of those 3 million of losses in terms of a carryback to either 2019 or 2018. Now, 2 million for many businesses will be quite a generous amount, but if a company is a member of a group, that 2 million is shared between all group members, so an individual member of a group may only be able to have a much smaller amount of loss carryback under these rules. In some cases, the group may have to notify how that 2 million is shared to HMRC. And talking of compliance type measures, if you want to use this extended carryback, you have to make a claim. That claim will normally be in your tax return, but if the amount of losses which you are claiming under these rules is less than 200,000, it should be possible to claim relief outside your tax return. But hold your horses, you can only submit those claims once the finance bill has got royal assent, which should be around July this year. And finally, if you're an unincorporated trader, be aware that a similar relief has been introduced for income tax purposes. So it is a support for all businesses, whether incorporated or not. Which brings us now to the super deduction, which is basically a special supercharged first year capital allowance for CapEx on new qualifying plant and machinery. Again, it is a temporary relief, and here the temporary period is that between April the 1st, 2021 and 31 March 2023. And to qualify for the super deduction, your expenditure must be incurred between those dates and, importantly, incurred under a contract entered into after budget day, which of course was the 3rd of March this year. There are two types of super deduction. The headlines went to the main relief, which should apply to most assets, which is 130%. So for every £100 you spend, you get 130 of tax relief. But there's also a slightly less super deduction, which is a 50% relief, where the asset on which you are incurring the capex would otherwise be in the special rate pool. In addition, there are circumstances where you might get slightly less than the headline 130%, and that's if you incur expenditure before 31 March 2023, but the accounting period in which you incur that expenditure goes on beyond that date. Here there's a proportionate reduction in the amount of the super deduction. An HMRC give an example of a company with a 31 December year end where the relief would be scaled down to 107% if, and provided if, the capex is before 31 March 2023. There is one catch to be aware of in relation to the super deduction, and that is what happens when you sell the asset on which you have claimed relief. Here, disposal gives rise to an actual balancing charge, which may give rise to tax being payable, and that's because your super deduction asset is not treated as part of your pool when you make a disposal. And in certain circumstances, that clawback could itself be supercharged. If you're not eligible for the super deduction this year, because, for example, you've already entered into a contract, then be aware that there is some compensation for you, in that the government has also announced that the annual investment allowance will be maintained at £1 million until the end of this year. So, two very different reliefs, but hopefully able to assist businesses deal with the impacts of COVID. Thank you for watching.